Welcome back to AC Spencer Trades, and today I'm giving away so much sauce. I can't even believe I'm giving away this strategy, but I'm going to do it anyway because I love you guys, and this takes range trading from a nightmare into an absolute dream. So before we get started, make sure you subscribe and give this video a like, because I promise you I'm not going to let you down. We've got the list of criteria which we need here to get into this trade, and honestly it is one of my favorites to trade. You can trade it on any asset, you can trade it on any time frame. You only need one time frame to trade it, so you're not having to confuse yourself looking at multi time frames. And the checklist literally consists of 5 points. One of those points being marking a range, and another one is seeing a 2 candlestick pattern, right? Not exactly rocket science. So the first thing on the list is how to establish a range, right? Because one of the most important things about range trading is being able to spot the range before everyone spots the range, right? It sounds really stupid, but when you're in a range that looks like this, right, it's been chopping around for ages, you have not got long left in this range before we see a breakout, or we see a false breakout and then a continuation to the upside. So it's really key for us to actually be able to spot this range as fast as possible. And I've got a few little secrets up my sleeve which I'm going to give you guys today. There's 2 pieces of criteria which should be met before a range is developed, and this is going to allow you a really good opportunity to get into a range, right? So say for example we're in an uptrend here. Now what we're looking for is a pullback roughly, well, a minimum of 90% of the previous leg, okay? So this being the leg here, we're looking for a pullback of 90%. So that is criteria 1 checked. The next thing which we need to see is a failed high, okay? So we can wick above this level here, but we don't want to see candle bodies close above this level here. Now that is then your range established, okay? So you go from this low up to this high, and that is including candle wicks, right? That is all you need. So you need 90% pullback, and then you need a failed high / low. Of course, if we're in a downtrend, this is the reverse. So price is coming down. Oh, this pen's dying on me. Price is coming down when we come back, right? So we're looking for the continuation here. This is our 90% mark, roughly. Obviously, we're on a whiteboard, so this isn't exact. We pull back into that 90%. We fail to make a new low below here. Now we're in a range. This is the top of the range and this is the bottom, okay? And then we're looking to ping pong in between these levels. So that's it. That's all it takes to do checkpoint number 1, to establish a range. The 90% pullback and the failed high or low. That is, at that point, you are now in a range. So I would be happy to short the market from here as soon as we get this failed high, and I'd be happy to buy the market when we approach the bottom of this range. So let me clean this board off. I'm going to show you guys exactly now how we go through these 5 stages, where the stop loss is positioned and where the take profit is positioned. So now, once we've established the range, we're looking for the 0.25 and the 0.75 of the range, okay? So we mark up the high and we mark up the low, and then I like to include these buffers. So you can see here that we've got the 1.2 and we've got the minus 0.2. Now this is because trading isn't perfect, right? So we need to allow for a little bit of a buffer on either side of the high and the low, because I'm sure you guys have seen when you're inside of a range that sometimes you get these little legs up and these legs down, which kind of just clear out any positioning, any stop losses, or any sell orders and buy orders which are placed above and below the range. And then we often see the reversal from there. So I like to include this little 20% buffer just to allow for that. And we can still have wicks come out the top of this buffer. That's no problem at all. We just want to make sure that the candle bodies stay inside of that 20% buffer. If I see a candle close outside of it, then I'm probably going to just say time to leave this particular range alone, and we can come back and visit either another asset or look for trading a different type of strategy, maybe some form of breakout strategy, right? Now, anyway, so what we're looking for here, this is our range, and then down below here we've got the stochastics. So when I say that we need to come into the 25 or the 75, I'm talking about this area here, and I'm talking about this area here. So when we're in the 0.75, we want to take sell positions from here, and then when we're in the 0.25, we want to take buy positions from here. So we're not fixed in one direction, we can still trade in both directions. Now, the favored trade is always going to be in the direction of the previous trend. So if we were in an uptrend, then we start this ranging move. The buy trades are going to be more favored over the sell trades, simply because you are trading with the direction of the previous trend, which should carry more momentum and more speed, but that's not a fixed thing, right? We are still capable of trading from both sides here. So now what we're looking for, let's say price comes into the range here, we create this high, we create this low, and this is now our range set in place. So what we're looking for from here, now we can start to look at buy positions from this low here. So we want to see some sort of divergence on the stochastic. So to create that, we have to create a new low on price action. So we create this original low here, then we need to create a new low on price action. And if we come over here onto the stochastics, it's going to look something along the lines of a low made there, and then a higher low made on the stochastic. So we can see if we pull this dashed line down to here, this is the low which gets made on the stochastics with this low on price action. Price action makes a new low, but the stochastics fails to make a new low. This is a higher low, right? And then what we're looking for is the reversal from here. So once we've got this, so we've got the range, we've got the 0.25, that's where we're trading out of at the moment. We've got the stochastic divergence. Now the next piece of criteria that we need is the stochastic crossover, right? So this is going to look something along the lines of this, right? So this point here, once we've seen the divergence and we see this crossover, the last thing that we need on the list is a 2 candlestick pattern. So this could be a bullish engulfing candle where we engulf the previous candle, or we can also trade a piercing pattern where we just close over the 50% mark of the previous candle. So something along the lines of this. These are the 2 candlestick patterns which I would be happy to take in here. And then we would enter into the trade once we see that candlestick pattern, say here. Stop loss would go below the low here. And then we can target back up to that 0.75. So this becomes our reward, and this here becomes our risk. Now we can of course catch the reversal of this trade as well. So let me show you exactly how that works. So for example, this trade goes something along the lines of this. We tag back into this 0.75 region, and now we're already watching to see if we get any signs of a reversal, okay? So we create this high here, then price comes back down and we create a new high on price action. So now the stochastics, I'm not going to draw everything in between here because it's not really very relevant. We're looking for a high to get made here on the stochastics, a pullback like we see here, and then a failure to make a new high before we then see it continue lower again. So the moving average, again for this, is going to look something along the lines of this. So this becomes the crossover, right? So we can see we've made this high on price action, we've made a new high on price action, we made this high on the stochastics, we failed to make a new high on the stochastics, that's the divergence, price action making new high, and the stochastics failing to make a new high. Then all we need is our candlestick pattern, which comes in here. We've got a big bearish engulfing candle, which we see form. So that becomes our entry point in here. Stop loss goes above the highs, and we target back down to the 0.25. So this becomes our reward, and this here becomes our risk. Now, you're probably thinking, why are we only targeting back down to the 0.25 or the 0.75 when price often comes down further and takes up this region here? Well, the reason for that is just a safety measure, right? It's up to you whether you want to have two entries and maybe you have one run back down to the 0 or up to the 1, and then you have the existing one which comes to the 0.75 or the 0.75 the way that I trade it. Of course you can do that. I've just found from the back testing that I've done and the research that I've done that it's much more beneficial to get out at this 0.25 or at the 0.75, because often price will come down to this level and then reverse away from it and then continue back to the other side of the range and potentially even break out above, which then turns a break-even trade, or what should have been a winning trade if you just took it to the 0.25, into a losing trade, which is exactly what we're trying not to do here. Honestly guys, do not sleep on this strategy. It's incredibly basic. I always say if you can't write your strategy on the back of a napkin, it's probably too detailed, right? And this is the perfect explanation of that. You're establishing a range. You're working out where the price is in the 0.25 or the 0.75. Easy. Stochastic divergence. Easy. Stochastic crossover. Easy. Two candlestick pattern. Easy. Stop loss position. Easy. Take profit. It's all so black and white, right? You literally cannot get this wrong. The only thing which develops any sort of challenge is learning how to establish the range. This takes a little bit of training your eyes, but I've shown you guys exactly what you need to do now. So this is the first step, is to go and learn how to establish a range. Once you've done that, then get comfortable using the stochastics, and by that point you should be comfortable with candlestick patterns and working out whether price has crossed the line or not. That should be straightforward enough for you. So that is what I use to trade ranges, and it's worked very well. I've used this for quite some time now, and it really is a great way to trade. I find it's the only way that I trade with the stochastics. I don't like to trade stochastics in a trending market. I feel that they're only really good for this ranging market strategy. So please go and give it a go. I think you guys are going to really enjoy it. Let me know down in the comments how you got on. Like, comment, subscribe, and I will see you in the next one.